The Access to Capital educational series, The Fundamentals of Startup Financing, is made possible by the generous financial support of the Truist Foundation. Access to Capital is an educational program of Verge and its affiliates, RAMP, the Regional Accelerator, Roanoke Blacksburg Technology Council, and its partners, the Launch Place, the Appalachian Council for Innovation, and Blue Ridge PBS.
We are so grateful to have with us Varun Sadhana, Vice President of the Launch Place. Varun, welcome.
Thank you, Lisa. And good morning, everybody. Glad to be here.
So, Varun, we're going to be talking about investing, and I'm just going to kick us right off. Can you tell the audience about the LP and types of seed stage investing your fund does?
Yeah, definitely. So we are the Launch Place. We are based out of Danville, Virginia. That's where we are headquartered. We also have an office in Research Triangle Park. We are a venture development organization. We are unique in the sense that we are not like an angel fund or angel network, but we are more of a comprehensive venture development organization. And for us, it is not only just investments. So how I classify our areas of business is three buckets. We provide consulting services to small to medium-sized businesses in the region. The second, and what we are talking about today, is investment. So we invest through our early stage funds. We have two funds, pre-seed 2 and pre-seed seed fund 2. So we are investing out of two funds, pre-seed and seed fund. And the third bucket of our business is more of an ecosystem building, where we help entrepreneurs, anything with market research, if they require like expert advice, mentoring, training, and like location. So we provide a comprehensive service. So basically, again, three buckets of our business. Consulting services to small to medium-sized businesses, investment through our pre-seed and seed fund, and then helping the regional ecosystem with our services. So in a nutshell, that's our investment funds. You ask about our LPs. So basically what we look for is our LPs. So we are a committed fund. We raised our funds through institutional private foundation, Dan River Foundation out of Danville. And the investment, typically our investments are like pre-seed and seed.
Okay, so you've got a lot going on. How old is the Launch Place in the fund?
So we have been in business. Our parent organization, umbrella organization, the Launch Place. We are doing business as the Launch Place, but our legal name is the Southside Business Technology Center, and we have been in business since 2005. But we rebranded and launched the funds in 2012. We made our first investment in 2014. So we have been actively investing since last 10 years, seeking new opportunities, helping small businesses, helping tech companies and startups. So yeah, right now we are celebrating, this year is the 10th year of the Launch Place. And with this, we have seen ups and downs, invested in early stage companies, had our share of exits, and again, right now seeking new opportunities to invest.
Fantastic. Well, congratulations on all that history. I'm sure you've seen a lot of different deals and have a lot of expertise to share. So we appreciate you being here.
Thank you.
So I'm gonna ask some more questions that we have gotten from folks that are interested in the work you do. How do you define seed stage investing at the Launch Place, and how much capital is typically invested in seed stage funding at that stage?
Yeah, great question. So since we have two funds, right, like we have a pre-seed fund and a seed fund, so the stage of investing is a little different. I'm going to go with the seed fund first, because that's the fund that we launched first. The seed fund, we will invest anywhere from $100,000 to $250,000 in typically a first check, right? Our average check size is $250,000, but over a period of time, we'll take a position of $750,000 in a company. That doesn't mean that we, if Lisa's company is presenting to us today and everything goes well, we are going to write a check for $750,000. That's not going to happen. But if everything goes well, the company goes through a process, we might be able to write a $250,000 check in first go, and then keep that dry powder as the company needs more capital. We try to become a capital provider on top of like expertise that we can provide. So as you are raising your next round, you typically, a company may need a bridge round. So we can, as an investor in the company, if the company is making good progress, meeting milestone, meeting revenue targets, we can come in and provide more capital. So over a period of time, we'll go about $750,000 in a company. The pre-seed is a little different. So the way, just to give you a little bit more background on how it happened pre-seed, we launched the seed fund, but we were also seeing some good deals that were fairly early and may not meet our risk criteria or investment thesis. Say that that the launch place can invest like $150,000 or $250,000, right? But we like the idea, we like the team, but it was way too early. And sometimes whenever that happens, and you probably will know, you don't invest in those company at that time, and those founders, they may leave the region or seek capital from outside the region or move to the typical places like Silicon Valley or New York or Boston, right? So we saw that opportunity and we decided to launch a pre-seed fund so that we don't have to worry about that. But at the same time, with the pre-seed fund, so the way we structured this was we'll invest anywhere from $20,000 to $75,000, not $750, but $75,000 in a pre-seed stage, mostly based on tranches. So we'll set up with the company, we'll set up some milestone. If you are able to achieve, then we are able to release that next tranche. So this way, we were not taking a risk of, say, $150,000 or $250,000. We were taking a risk of $20,000, $25,000, up to $75,000, but we were able to engage with the company early on. So for them, for the companies, it is good that they know that they have found a capital partner, but also like somebody who can help, getting in front of possible clients, right? So we were able to do that. From our side, it was good that because we are able to see the progress of the company firsthand, we can talk to their early customers. We can get get feedback from beta customer, and if we see that this partnership is not going to work in long run, then we don't have to invest or consider from our seed fund, right? So it worked out great. So yes, so it's a little different thesis for pre-seed and seed, and during this whole session today, I'm going to overlap between like pre-seed and seed, but it is totally different. Seed fund, we will invest anywhere from, just going back, we will invest anywhere from $100,000 to $250,000. And from pre-seed, we will invest anywhere from $20,000 to $75,000. Yes.
Okay, so this is really interesting. It reminds me of a phrase I heard recently, and you just basically gave the example of making sure that the resources that are brought to bear in the work that we do is age and stage appropriate, right? So it sounds like you identified this stage, pre-seed stage funding, where you could tap into, provide some funding, but also some wraparound coaching, mentoring, advising, and see what's happening with the company there at that stage, which is fantastic. So our audience is interested. What does it take? At what point are they ready for that bigger slice of the investment funding, seed stage funding? The early part, it's really critical, but everybody's shooting for those bigger dollar signs, right? So what does it take at what point are they ready for that seed stage funding?
No, that's a great question. And again, like that is also the time when, the founders are just entering into the industry. They may have idea, they may have a prototype, but it's a very small community, right? Investment community and entrepreneurs, right? Like, so it's very difficult for some time for entrepreneurs and founders to break into. And sometimes it is difficult to get to that seed stage. So with the pre-seed, what we have done is we try to make it very simple. Everything is a little bit lighter on pre-seed side. As you can see, like the investment dollars are lighter. So with that, the due diligence is a little bit lighter on our side. The time frame, like it takes for us to make a decision, it is a little less. But like what it basically takes is that for pre-seed, in theory, the way we have designed it is we will invest up to $25,000 for technology validation and $50,000 for market validation, right? So I'm going to walk you through an example without giving names, right? We identify a company early on, like 2013 or 14, right? Pre-seed, this was founder that we liked the product, we liked what they were doing, but at the same time, the product, the beta product, it was basically a garage prototype, right? It was functioning, but it was nothing that a customer will buy at this time. And we liked what he was going to do, but it required some validation, right? So we decided that we will invest $25,000 in the company, and with the founder, we set some milestone. We trusted the founder that, hey, this is what the product is going to do, but it requires a third-party validation. So we invested that $25,000 for the founder to work with a third party to get some validation study, which was good for us to make sure that product works and does what it was supposed to do. But for a founder, it was also very critical because now it gives them a validation when they're talking to other investors, but at the same time, when they're also talking to their potential customers, right? So for pre-seed, we can come in like before the company has revenue, right? And we'll look at companies that are pre-revenues, but may have a garage prototype or prototype, but require like some kind of technology validation and market validation. So we'll come in, invest a smaller check size, dollar amount, and then hope for some like early customers that, the beta customers, and get some feedback from them. And if the company is able to meet all those milestones, by the way, we do set like milestone, but it is with the company, right? So the milestone are not like, hey, you need to sell 10 products, right? Like 10 products. Like the milestone, if you don't have a product at this time, the milestone could be technology wise that, hey, let's have a beta product at this time, right? Or like, let's build like 10 prototypes so that you can get validation. So we work hand in hand with the entrepreneur, with the founder to set those milestones, right? And which are reasonable, achievable, but at the same time that it will signal us if those milestones are achieved that, hey, the company is ready for like seed capital.
Fantastic. So if you had to list 2 or 3 criteria that they are must-haves for you to invest in seed stage, what would those top 2 or 3 things be that have to be there?
So, and again, like for different investors, different funds, it is different, right? Like depending on their risk appetite, depending on their investment thesis. For us, I would suggest like, and it may sound like as a cliche, but at early stage that we are investing in, we look for a good founder, right? A strong CEO founder with I would say strong domain expertise, right? Like that understand the industry very well and who can execute, right? At this stage, it's execution is very, very important, right? Like, and so it is important to, you are investing at this time as you're basically investing in the founder and the CEO, right? So it is important. So, it may come across as a cliche, but I think that is very important for us. The second thing is market opportunity, right? The size for a fund like us, we are managing a portfolio, right? So we have to look at return and exit. We have to look at exit, and for that you need to have like a substantial like market size for a company to work, right? When they can have a substantial exit. So that is also important to us, that how big of a market opportunity it is, right? The product or the company industry they are functioning in. And the third I would say is, since we are a venture development organization, we are a double bottom line fund, like I said. So we are also looking for economic impact. So yes, we are looking for a return on capital like any other fund will, but at the same time, we are also looking for like that regional economic impact. We call it Danville impact. So the company needs to commit to creating some jobs. How we are quantifying is that the company needs to create minimum of 5 jobs over a period of 3 years. So for us, that is also very critical, right? Yes, if a company can say that, hey, we'll have a very good return, 10x return, but if they cannot commit to our impact requirement, then it may not work for us, right? I would say the team is critical to us. When I say team, at that time, the company may not have a team, but like the founder, CEO, right? The second is the market size opportunity, right? And the third, I will say, is Danville impact. Not in any order, but those I would say are the 3 typical things that we seek, at least when we are doing like early screening of these companies, right? Like, hey, can they meet these requirements for us, right? Before we go deep
Sure.
in conversations. Yeah.
Yeah. So understanding those being top things that you're looking for in any investment that you might make, do you also have focus areas or industries that you focus on seeking to invest in?
Yeah. We definitely know what we are not going to invest in, right? So I'll start with that. We are a smaller fund, committed fund. So we know that, hey, if a company requires, like, it's a biotech company that requires substantial capital to bring the product to the market or like have a possible exit, then we are not going to invest in. But typically we are agnostic. We also look for like how we can add value to the company, right? So we are not going to be, when we invest, we are not going to be managing the day-to-day operations of the company, right? But at the same time, we are not going to be a passive investor either, right? So we want to add value to the company. We want to help the company. So we look for like how we can help the companies directly from the staff of the launch place, but from our broader network, our investment committee members, our board members, our portfolio companies, right, that we have already invested in, so how they can help. So we look for all those factors when we are helping a company. So, that is also important when we are considering the investment, like industries, right? And the overall, like, what's the assets, right, around the region that can support the growth of that company. So we to just to answer directly your question, industries that we look for, I will say like typical, like we'll do SaaS, we'll do health tech, we'll do like advanced manufacturing, agriculture technologies. So we are fairly broad. We have done like CPGs as well, right? But with maybe e-commerce CPG, right? But that's not like something that we do regularly. But to diversify our portfolio, we have invested in CPG as well. But we look at it again. Every opportunity we'll look at it. But if it is like a substantial capital, biotech, that's something that we won't consider. But advanced manufacturing, SaaS, IoT, health tech, education technologies, we'll consider those.
Fantastic. So last question, we're getting close on time. So I want to make sure we get some of those last pieces that we wanted to touch on with you in particular. How long does this process, when should people be in touch with you at the launch place? And as far as seed funding, not pre-seed, but seed funding, how long does that process typically take to go through?
So if I'm understanding correctly, two questions, right? Like when they should start like contacting us. right?
Correct.
I would suggest, and again, this is a little bit personal as well. I think it takes time, right? Raising capital, it's not easy. Founders will tell you that, investors will tell you that. So I suggest like making those contacts early on, right? Like when you are beyond like an idea, start having those conversations, right? For us, the launch place, me, right? Like I don't mind getting contacted by a possible companies, right? Like to get a feedback from them where they stand. So making those early contacts, it is good, right? We want to monitor the progress of the company, right? Because it's very unlikely that somebody will contact you that you will decide that, hey, yes, let's bring them in front of our investment committee. It also happens, but like if you're a very early stage company, you want to make sure that you make those early contacts with the investors, right? But for us, our typical process is, I would say, once a company makes a contact with us, it can, like, after we go through our investment committee meetings, it can take like 60 or 90 days to finalize the diligence and make an investment decision. And then it is also like negotiation when lawyers come in from both sides. And the more you do it, like, no offense to any lawyers, right? Like, but it can, if it goes back and forth, that can take a little bit more time in closing, right? But our typical process, we say, is that it can take like 60 to 90 days for us to make a decision. Also, we are very careful with the time of the founder, right? So if at any stage, and we are in diligence and we find something like red flags that are going to be questionable for us, or like it doesn't meet our investment thesis, we want to make sure that we pass that information to our founders like as soon as possible, and we don't waste their time. So it's not going to be like, hey, if we know that we are not going to invest in a company, like say within a couple of weeks, with like early conversations with some of the customers or potential like partners, then we are not going to wait until like 90 days to tell you that we are not going to invest, right? Like we'll make
Right.
that decision sooner, because again, we don't want to waste anybody's time. So yes, once they make a contact with us, 60 to 90 days is make a decision.
Well, speaking of time, we're out of time, but we so appreciate you giving us that's a very quick look inside the launch place and how entrepreneurs should think about the launch place, what kind of opportunities are there, when to be in touch. This has been fantastic, and I hope you get lots of calls from
I
lots
hope
of.
I hope so, Lisa. This was fun. Again, a quick spiel. Like I said before, I am like a phone call and email away for founder, right? Like even if in not work during that time, you need to make those relations. You need to make sure you are in front of investors, right? So yes, I'm just a phone call and email away. Feel free to reach out, and we'll share more information about the launch place and other services that we provide.
Fantastic. Thank you so much for being with us today, Varun. We look forward to partnering and working with you around the region.
Same here, Lisa.
And thank you for joining us today as we talk with Tom Weithman, Managing Director of Virginia Venture Partners, talking about seed fund investing for entrepreneurs. Tom, tell us a little bit about the work you do and the organizations that you work with.
Absolutely. Well, we are a seed fund here in the Commonwealth of Virginia. We are a part of Virginia Innovation Partnership Corporation. Indeed, Virginia Venture Partners is the brand name used by the investment division of that nonprofit. We've been at this for about 16 years now, in making direct investments in high growth seed stage companies around the Commonwealth, investing largely in tech, in life sciences, and in clean energy. More recently, we've taken a look at other sectors as a way to expand the lens a little bit, including maybe getting away from technology a little bit and expanding into scalable non-tech product companies.
Fantastic. Well, here in Southwest Virginia, we are really grateful for all the support from Virginia Venture Partners. We've had several startups that have received funding and definitely have made it to the next stage with that support. So we have a couple of things we want to know for the entrepreneurial sector. What are the 2 or 3 key investment criteria that you look for when you're making a decision about investing in any company?
That's a great question. I think at the seed stage, we look at the team. We spend a lot of time looking at the team as well as the technology. The team is critical because at this very early stage, so much of it turns on the people and their ability to execute. So primarily as we look at a team, we're looking at a balance, if we can achieve it, of tech and business acumen. You oftentimes at the very earliest stage don't have both together. So if there's purely a tech founder, we look for maybe someone around them as an advisor who brings that business ballast. Regardless of whether the founder has more of a tech or a business orientation, we're looking for full-time commitment on the part of that founder to the company, someone who is deeply embedded and ready to roll forward on the entrepreneurial journey. So full-time commitment with the team. The second thing we look for as a Virginia funded fund is a commitment to the Commonwealth of Virginia. We look for companies that are headquartered here and have an expressed desire and a plan that enables them to grow and contribute to the Commonwealth over the long term. That's very important to us. Finally, we are largely a science and technology-based investor. And while we are examining other sectors beyond science and tech, we have historically looked for companies and investment opportunities that find their differentiation in science and technology. And it may be a hardcore patent position in the form of a life sciences company, or simply a hard to replicate feature with a software company, or someone that has a significant head start on a hard to replicate technology.
So I bet you get to see a lot of leading edge kind of technology.
Oh, we do. It's exciting stuff. There's never a dull moment.
Yeah, fantastic. I love that part of my work. Does Virginia Venture Partners have specific industry areas of interest? You said tech and science and tech. Are there specific areas inside of that description that you're looking at in particular?
Well, indeed there are. We are. I will say that we tend not to get too glued to thematic investing. It's hard to do that when you are bound to invest in a circumscribed geography. But we bracket our three major buckets of investment activity in tech writ large. Tends to skew toward software. With software, it's more B2B than B2C, but we've really run the gamut. A lot of enterprise, mostly SaaS, increasingly with an element of AI, machine learning, big data involved with it. And we see this pointed at various industries. We see health tech, we see prop tech, we see reg tech, we see a lot of cybersecurity. We've done, of the 270 some deals we've done, about 80 of them have been in cybersecurity.
Is that a new trend? Is that trending up for cybersecurity for you guys?
That's probably stayed pretty level. I mean, we just, by virtue of our proximity to the nation's capital and the technology base around the Washington, D.C. area, and some of the competencies we see in Virginia's universities, that seems to be kind of a natural fit for the early stage company deal flow. Our second big bucket of investment is in the life sciences, and we've really run the gamut from pharmaceutical, biotech, to diagnostics, to instrumentation, medical device stuff. And finally, clean energy. And we've done a few things in the energy area, largely outside of, largely in rural Virginia. We've invested in alternative energy. We've invested in smart water heater technology that integrates with Nest in the home. So quite a range and really interesting stuff. Those are the three big buckets of investment activity. As I mentioned, we're examining possibilities for scalable non-tech, non-science related companies like consumer products that haven't traditionally been available.
So this might be a question that you've touched on it a little bit, but I just want to confirm one way or the other. Does VVP only invest in Virginia-based companies, or could there be some sort of hybrid geographic location for the company?
Well, that's a great and a timely question, because place-based investment isn't what it was in the 1980s, and certainly isn't even what it was pre-COVID, as people relocated and teams became ever more distributed. And now with just the talent shortage that faces so many science and technology-based businesses, people hire where they can. The way we look at a Virginia business, we like to see a headquarters here in the Commonwealth. We want to see a company licensed to do business in the Commonwealth. We would have said pre-COVID that we want an office space where the C-suite is coming to work. We may look for evidence of Virginia-ness by seeing where the preponderance of the cap table is, the majority of the ownership of the company is at the time we invest. We have gotten a little bit of relief on that definition by our board that will enable us to invest in companies who have headquarters outside of the Commonwealth, as long as they have a substantial presence here. And substantial is left room. We have a little bit of wiggle room on that. But we want to see in that instance, if someone is not headquartered here, we would want to see a path toward job creation over the immediate handful of years following our investment. And we can carve out, I think, up to 20% of our portfolio for that. So by and large, we are still looking for companies that are largely domiciled, or at least the headquarters and strategic activity and the majority of the C-suite are here in the Commonwealth.
Yeah, that sounds like a similar trend that we're seeing with the work we're doing, where more distributed teams and the definitions of flow around job creation are a little fluid now because we're in different times. So it's interesting to hear how that you're adapting to that. What process do you see that founders should follow to pursue funding specifically with VVP? Is there a particular way they should start that process?
So I think we are not dissimilar from other private equity venture funding sources. Is build the relationship well in advance. It's easy for, we make a seed stage investment, and there's so much, as I mentioned earlier, turns on the people aspect of it. And you really want to feel that you know the people and know their capabilities. Of course, there's no substitute for getting to know someone than simply time spent with them. So it's in the absence of that, then it's helpful for us to get something by way of a warm referral from people who know the company and people that we know well who we work with. So that's always a good intro. So a couple different ways I would suggest. Number one is, in advance of needing the capital, build the relationship with us. We do a lot of outreach activity. Every other Friday, we hold our Coffee with Virginia Venture Partners series. We show up on that, participate in the community, because it isn't just a deal flow funnel for us. It really is a method of building a community around the Commonwealth. So we encourage you to get engaged that way and to reach out to us to let us know how you're doing, how the company is developing. In lieu of that, or supplementing that, a warm referral can also be very helpful. The strongest warm referrals are from people that we've invested in the past, people in our own portfolio. Those are extremely powerful, or people who have been in our portfolio in the past, or people we have invested with in the past. Then there are also service providers that may know us, or any number of acquaintances. But to the degree you can leverage, I think, not just with us, but any investor, that kind of longer period of time of building familiarity, building confidence and comfort, and or coming through a warm referral, it's incredibly meaningful.
Yeah, that it does seem to still hold true in every sector that we work in. The more time that people have to get to know each other, the easier it is to build that trusting relationship and to move forward in something that really becomes a long-term relationship, right, that you're building. So speaking about the processes, what does your investment decision-making process look like all the way along the line, start to finish? And how long does that take? I understand what you're saying. People need to start a relationship and get to know you. But once you're interested in somebody in an investment, how long does all that take? And what's the process look like on your side?
We've done deals in as little as 21 days. And
wow.
That didn't go well for us. So that's not the model that we follow. We generally feel we're probably a 90-day trajectory. It really depends on the readiness of the entrepreneur. We've taken as long as 3 years to make an investment in companies. Again, depending on the readiness of the founder for the investment process, depending on the readiness of the market and the technology that they were purveying. So 90 days is probably a pretty good average. The way our process works, again, we don't think we're dissimilar from the way most funds operate. There's some intake of the company by in our process or by a member of our team. So generally, we will get things over the transom, and we have a CRM that we use. It's available through the Virginia Venture Partners page on our website. It's a web form the companies fill out and provide us with some basic information. We encourage them to attach an executive summary and a deck. Alternatively, sometimes people will come to us through our network. We still encourage them to go back through that process. We drive them back through that process just for ease of management, because we don't want to let things fall through the crack. And we do try to close the loop with everyone who approaches us, so there's some response. If I look at our pipeline now, we've got 49 companies at various stages, and that varies week to week. We have Tuesday deal flow meetings where we Thursday. Monday, we review the pipeline. Thursday, we review companies. So we have a steady influx of companies that we got to check on every Monday and move things through the funnel as we progress with diligence. So after that initial intake, that we usually have whoever's sponsoring a deal, whoever gets hold of it first, has an initial call, a screening call. Sometimes bring in another member of the team. We generally have a senior member of the team and an associate that are looking at the deal together and make a preliminary cut as to whether more diligence is required and whether to advance it to a more full review. If the decision is made to advance, and the decision may be made to continue diligence or dig into it or do some research on the sector or space, if it's something we don't know or haven't seen a company in, the company would then advance to a meeting with the team. And we do take, this is where we may differ from many venture funds. We take an unusually collegial approach toward evaluation of companies. We really want to hear diversity of opinion around the table, and our best investments have taken place when we've had that. And some of our investments that haven't worked out, you can always trace back and see, well, this one individual had this nagging feeling that something wasn't right or had a diverse opinion and questions that weren't adequately resolved. So we really do listen to everybody, and we'll bring companies into our Thursday meetings to pitch the team, and we score them along certain axes to make a determination on whether they advance to the next level, which is ultimately our investment committee. And for larger dollar investments of, 200,000 above, we use an external investment committee, 3 committees organized around those 3 main themes of tech, life science, and clean energy. So less than $200,000, what we term a pre-seed investment, we have an internal investment committee meeting consisting of myself and members of the investment team that cast a vote. They've already had a look at it, but look at it in a more formal way. Following that, we take on any concluding diligence, and that includes doing a deep dive into the business formation, any material contracts that a company has or material obligations that they have. We want to make sure we understand the cap structure, the out-year capital requirements. We check how the company is formed, everything about the business, and then we move it toward close once those questions are satisfied. So I think a fairly standard process. Generally, it's the deal sponsor, that initial senior member of the team that takes the board seat, and we take only board observer roles rather than a formal board seat, just to limit our own organization's liability. But that generally that individual stays with the company and works with the company over a longer stretch of time.
So I'm thinking about this process, and I know it's not one of the questions we had talked to you about beforehand, but I'm thinking about this process and how many deals that you've been exposed to over the years. What would you say is the most common avoidable mistake that you see when somebody gets into this process and they get really close, but they've made a mistake that just kicks them out of the process that they could have avoided? Do you see people making mistakes that they could have gotten advice before they got in process, maybe avoided something?
So I'm not sure there's one single thing that would kick somebody out, because oftentimes we'll find something wrong with a presentation or the fact presentation that we can correct. And generally, if there is something that we don't think we can correct, we will have caught it earlier on. What is an automatic deal killer for us is any suggestion of misrepresentation. And we've had that happen, and sometimes over fairly trivial things, but a blatant misrepresentation. There's nothing that sinks confidence in another individual faster than that. And that generally we haven't been able to see our way around. In fact, we don't, because if misrepresentations are made in small things, then misrepresentations can be made in greater things. Conversely, I'll tell you what does really excite us. And that is when we get off script, and we like to see people that can comfortably come off script of the presentation and engage in meaningful question and answer, and respond candidly if they know the answer or if they don't know the answer. But people that can go kind of off script or off road of their deck and really dive into the elements of the company, the market, customer response, competitive response, what the financials are likely to look like. I say likely because things always change. That's a big confidence builder for us. I'd rather see someone that is a terrible canned presenter do well in the Q&A than the converse.
Yeah, that's really important to me, because as soon as somebody gets comfortable and they can, like you said, navigate a conversation around it, it is a trust builder, right? They know what they're talking about and they're comfortable with it. I particularly look to see if somebody's done some of that customer discovery, right? They've gotten out there and they know something about the landscape with the customers. It's good to see if they can have that conversation. This has been really great, Tom. I so appreciate you sharing your time and expertise with us. Any last words for our audience about this process of applying for seed funding through VBP? Anything you want to share with folks that you want to make sure that they don't forget when they apply?
Well, the only thing I would suggest is that we want to be available to everyone in the Commonwealth. We've got some exciting things going on with our organization and an expansion of capital by way of a federal grant, which we haven't even touched on, but we're really excited about, that will enable us to do even more direct investment and some indirect investment where we will take positions in other funding sources. So a lot of exciting things. Please introduce yourself to us as we are out and about, or if you're on one of our coffee events, we'd love to hear more from you and learn about what you're working on and see if we can be of assistance, if not through our investment program, through other resources of which we may be knowledgeable.
Yeah, I can't say enough about the coffee hour. I've been going to those all through the pandemic, and it has been an incredibly valuable gathering space. I've met a lot of people. It's a great place to learn and to network. I can't say enough good things. Thank you for hosting those and bringing together, what is it, on average, 50 to 75 people.
It's a pretty good turnout, yeah.
It's a great turnout. So great success. It's one of the takeaways from the pandemic that I think has been a wonderful thing that's come out of it for this space. So we appreciate you hosting that.
Well, thank you for that. And thank you for sharing a bit of your day with me.
All right. We'll see you around. Thank you.